Hello and welcome to the Timing Trades and Position Management video. Let's take a quick look at what we will be examining in this video. How open and closes affect markets. What brings volatility, an essential component of all trades. How you can choose when you trade, as timing is considered to be crucial. Exchanges versus brokers' timings. Timing your trades. When picking your time to place trades, there are four main factors that will always be important. The time of day. Markets do not have the same liquidity among all time brackets within the day. The yen will inevitably have more liquidity around Asian times, for example. When economic data is being released, markets tend to be volatile and erratic in their behavior before and after the announcement of economic events. Figures like unemployment data and PMI index will always interest traders who are seeking to make the most out of them. When key policy speakers are on the wires. This is especially true when there are announcements around the ECB, the European Central Bank, or the Fed policies. With the current environment of low interest rates and weak growth, the minutes of such meetings are very important to markets. How are you feeling at that point in the day? What have you experienced? This is all about psychology and mental state, as you will not be making the same decisions if you are upset with something else or if you have the pressure of making some money. It all comes down to at what point will you be the most profitable. This may sound easy, but it is extremely hard to implement. A very important notion about the markets and the way we trade them is the term volatility. The markets will be nervous when volatility is increased. This will revolve around the open, the close, but also around key announcements and sudden events. If you were trading the FTSE 100, for example, then the markets will be very busy at 8 a.m. when traders assess any overnight news and the markets open. Any news around the Bank of England governor or potential macro developments, such as the Brexit issue, will cause excessive volatility to the sterling. Likewise, at 4:30 p.m., the trading just before this may be volatile, while traders liquidate positions before the close. This is true for what we call intraday positions. A category of traders are only willing to take calculated risks within a trading day and never hold overnight positions. This protects them from certain macro events, but also from potential overnight bad news. Sticking to your time in your trades issue then, it is crucial to know that the exchanges run the various FX, bond, indices and commodities market operations. Your broker, however, will offer you their own prices based upon the underlying markets. This means that it is important to know the products you trade, when the cash open and closes are, and when your broker will offer prices until. Many FX markets, for example, will trade all day and all night in the futures markets. The above relates to the fact that the foreign exchange markets are essentially an over-the-counter market. That means that you are facing the FX provider in every transaction, so in essence, your counterpart risk is with them and not the exchange. This has become more of a norm after the regulation which allowed companies to become competition to the exchanges by providing trading facilities for products such as FX on their own platform. It might sound complicated, but what in essence means is lower latency, no delay in prices, much lower costs of execution, and an abundance of products to trade with at the touch of a button, something that was not available just a few years ago. When you trade via a broker or spread betting company relating to the UK market only, your trades will be affected by the open, cash open and close of various markets. By cash, we mean the spot market, as this is the basis to calculate the futures market. If you trade the DAX index, for example, on Eurex, then the markets open at 8 o'clock in the morning, close at 4:30 in the evening. DAX index is the German benchmark, and it is considered by many to be the barometer of other European markets. It tends to follow the US markets and is quite volatile, what we call a beta-sensitive market in our jargon. What that means is simply that the German index will respond more aggressively to any news as opposed to other European markets. This is true for the upside, but also for the downside. The same notion stands with FX. There are currency pairs which exhibit quite an aggressive behavior to news, and others will seem less erratic in their behavior. If you trade on a broker, your trade will be affected by, and this is all London time, the open 8 a.m., the US cash open at 2:30, the 4:30 exchange close, and the broker's market closing, usually 10 o'clock in the evening. Remember that all markets from FX to commodities are correlated in some way. Most notably, gold is traded in US dollars. So if there is movement in the US dollar, then there can be an impact on gold. Pick your trading times carefully around market operating times. This could just be a 2-hour window around the European opening times or the Asian closing times, a window that will make you comfortable in managing your positions. Referring to that, there is also time when market sessions coincide, such as, for example, Asian with European session in the early morning. This is where most would choose to trade, as it appears to be a busy time for all participants. Some would also avoid trading on a Friday, as people would be reluctant to hold on positions over the weekend, but also because the week comes to an end and there is not much to expect that could affect their trading. UK and European data will be released during the morning trading sessions. It is important to remember that UK and EU data usually has a localized effect. For example, strong or weak UK data will usually affect the FTSE and the cable, the sterling against the US dollar, and other UK traded products. USA data, however, will generally affect all markets. Being the biggest economy on the planet, no matter what you trade, USA data of high importance will move all markets. The Federal Open Market Committee is one of the key things to pay attention to, as crucial statements come out of it. Also, most NFP, non-farm payroll, GDP, and other large USA figures are released at 1:30 London time. This is when managing your trades is very important. If you are long or short around this time, your positions can be affected for the better or worse. There are many traders who choose to be neutral around such announcements, as they find that coping with excessive short-term volatility spikes may prove challenging, to say the least. Regarding the timing of your trades again, one cannot fail to pay extra attention to key speakers. Key speakers can have the same effect as data. Unlike data, however, the USA is not always the only main focus. All the three main speakers in the UK, the EU, and USA have the ability to affect the market by what they say. And more often than not, markets have to decipher their statements, as these are deliberately made in an unclear way. As if we did not have enough problems to deal with, these statements generally have to do with the fiscal policies and their views on growth, inflation, and interest rates. As the economy moves in cycles between expansion and contraction, inflation and interest rate policies affect the markets. Even the slightest hint of change to the better or worse may signal an increased volatility, and so opportunities arise. Mario Draghi, Mark Carney, and Janet Yellen all have the ability to move the market with what they say. These can be scheduled meetings or other times of the day. It might also be that the effect of some is more localized, but still quite important. Everything that we have been discussing revolves around the fact that you are the trader. Only you will know what makes you tick. You have to understand always how you interact with the markets. It is important to let the markets dictate you, but you always have the power. The markets will always be there. You don't always have to trade, and you don't always have to be in every move. One of the most important lessons in trading is letting the markets come to you. As long as you know what moves the markets, you can decide if you want to be involved or not. This is especially hard to do, as opportunities appear every minute and we feel obliged to take them. We feel out of the picture if we don't take advantage of all of them. But all you need to do is do exactly that. Let the markets come to you and trade when you like, not when people tell you to. Think about what happens in a trading day. Think about when you want to be involved in the markets. You schedule. Think about when volatility enters the markets, other influences. Put it together in a trading plan. Keep it simple. For example, take a look at this chart here. We have drawn some key lines here to denote that this is clearly an uptrend. All you have to do is really take a look at the chart. No indicators or fancy drawings, just a chart for the moment. From the breakout below, it showed signs of strength. It went up, then paused for a few sessions, then went up some more. This is an indication that you would ideally like to belong to this product based on your time frame. So you've got the big picture. Now you want to make a sound trading decision. You're not chasing the market, you let it come to you. You can work in order to place a buying position, for example, when it retests the regional lows, and define your take profit target based on your risk management rule of, say, 2 to 1. You place your stop loss and job done. No stress, no following the markets, no trading for the sake of trading, nothing that will affect your judgment. Just pure logic behind a bullish market like this one with a sound plan of execution. Done with the opening? Write it down so that you remember what was the reason that you opened the position in the first place, so that you know whether you will repeat or not the logical process. That is all there is to it, really, despite admittedly being tough to implement. Going back to the same graph, we have the previous day's trading. What can we get from that? In this example, the previous trend was down before the breakout. There were more sellers than buyers. What could then happen today? The trend could continue or reverse. What could affect the markets? The open, the cash open, any data or speakers, and then the close. Build your positions gradually, as timing is quite difficult to get it right. Some technical tools, like a simple oscillator, will help you determine that. But think that the market can remain irrational for longer than you can remain solvent. This is a common saying and a very true one. So if you get your basics right, working around event announcements and time will be easier, as they will not be determining 100% of your potential success or failure. It will also depend on your time frame as well as your trading strategy. It will not have the same impact for a scalper than it will do for a swing trader. Getting into the details of the position, your actual optimal trading period and area of volatility is after the cash open and after the data on this day. This means that you can focus a few hours on getting into a position or managing the position you are already in. By looking at the previous day's activity, you can get a certain bias. If the next day is not trading in the same way, you may need to wait for more confirmation. The open and closes and the data hitting the markets can help give you specific times to do this. How do we want to be involved in the markets with our schedule? Marked with red arrows on the graph, you can see the time of US cash open and US data release and the effect that these had on the chart. All in all, you have taken everything into account. So if the trade proves to be wrong, you simply know what went wrong so that you're aware next time, because you based your decision on logical processes and sound risk parameters. How many times we keep saying it, it will always boil down to the same principles. In conclusion, planning is always the key. You want to be involved in volatility, but only on your terms. You have to understand how and why the markets are moving. With or without your trades, the markets will move. You don't have to chase the markets. Key data and speakers, especially from the US, will move the markets the most. If you plan out the timings of these key events, you can determine if your existing positions will be affected or if you should open a new trade around this information. You have to determine what time of the day suits your trading needs. The markets will open and close like clockwork. Your job as a trader is to decide when you wish to be involved and why.